Hello everyone, I'm Steve Schneider, the National Marketing Spokesman for Brokers Alliance, and perhaps you've seen me on the internet on our show. My AKA is Steve Savant, host of the Business Insurance Zone. Today I want to talk to you about term insurance. There's so many people coming into our business, especially a lot of people coming from the health industry and wanting to learn about term insurance, permanent insurance, annuities. And so today I thought I'd take a little time out to kind of walk through the basics of term insurance. Now, when I think of term insurance, I think of a time certain event. Term is temporary expense reimbursement money. So if I died, what expenses would I have to pay because of my death? So temporary, in other words, how temporary will my liability be? Well, if I'm in a buy-sell agreement, perhaps I only have 10 years in our partnership. I'm only going to buy a 10-year term contract so that if either one of our partners dies, all of us who live will be indemnified by that. We won't suffer financially because of the loss of one partner. And so when I think about should I do term insurance or permanent insurance, if it's going to be a temporary liability, I'm always going to look at term insurance. Now, when I first came into the business, it was just annual renewable term. Every year the premium would go up a little bit more, and a little bit more. But then they started making guaranteed time certain contracts, and we start out at 5-year guaranteed level premium, 10-year, 15-year, 20-year, 25, 30, and believe it or not, here we are in the finishing off the first decade of the 21st century, and we're now offering 40-year level term. A few carriers, not a lot of players here, but still 40-year, and I wouldn't surprise me before I retire that we may even have 45 or maybe even 50 years for all I know. And then when I have those guaranteed periods, I'm going to match them up with my liability period. So if it's 20 years, then I'm going to be having a liability. Let's say I have a mortgage for 30 years. Well, then I'm going to look at 30-year term, see if that's the way to solve that issue, or if I'm going to have a 20-year buy-sell agreement, or maybe a cross-purchase agreement in business, I'm going to look at whatever period it is. Maybe it's 15, 20 years. I'm going to match my term insurance period up with that liability. Now, many carriers, not all, but many carriers also add on to their guaranteed level a return of premium rider. So suppose you bought a 20-year level term, and at the end of that 20 years, not only did you not die, but you paid your premium, you never replaced it, you stayed online with the company. They pay a little bit more for this rider, but you'd get all your money back that you paid out in your return of premium rider. Now you have to measure it to make sure that the economic value you're getting is really worth it. But for younger people, I think, especially for younger people, it's so cheap that you might want to look at ROP. By the way, how cheap is it? I was looking at a female 25 super preferred, and I noticed that her $90 policy fee was greater than her annual premium. That's how the mortality revolution is now impacting, especially the next generation behind me. These children that are now early teens, late 20s, the odds are they are going to see age 100, basic health, advancements in medicine. The Tricentennial Club is going to be something. So if the liability, if you're going to live longer and your liabilities are going to exchange, term is not for you. But if it's a time certain event, it's only a small period in time for mortgage or business, I'm giving you 2 examples, then you're going to look at term. Now, when I look at, I mentioned the phrase super preferred. Well, there are 5 different categories that are standard categories for health. And those health categories are determined generally by an exam. That exam is going to look at 24 categories in your blood and your urine exam. I think the euphemistic street name for it is a Chem 24 exam. They're going to look at this, and if you think we're not parsing your blood and your urine in exams now, think about the 5 different categories that I'm going to lay out to you. The top category being super preferred, the next one preferred plus, the next one preferred non-smoker, standard plus, and then standard. 5 different categories that are all managed off your attending physician statements, but more importantly, off your blood and urine exam, or this Chem 24 that I brought up. Now, of course, if you're a smoker, they have all kinds of smoking divisions and health categories, and it depends upon what you're doing. Are you a pipe smoker? Are you doing chew? Are you doing snuff? Are you doing cigar? Are you doing cigarettes? When you they'll want to know how long you've been doing this, how much you're doing it, like especially in cigar, smoke, pipe, And then of course chew, which I find personally revolting, but whatever. But you're looking at that, they'll mark that out. You can be a standard smoker, a standard plus smoker, a preferred smoker, although I find that a complete conflict in terms. Preferred smoker, I don't know how, I don't know how we invented that. So you have different categories, and it's all going to be based on nicotine use on this side of the fence. Now, when I've already established that my client has other issues, maybe they have health considerations, we can actually go substandard. So if we have standard and above, there's substandard and below. And there are 16 tables that go about 25% increase in mortality charge every table you go up. Now, per carrier, it's going to be different from carrier to carrier, but I'm just trying to give you a rule of thumb. So if my charge, like in my example with the young lady, maybe she's $75 annual premium for $100,000 10-year term. If she was actually table B, she might start to see a 50% markup because she went from preferred, the super preferred, all the way down to that number. As I get older, the charges get larger because I'm getting closer to the possibility of death. So when I'm looking at substandard, I'm going to be looking heavily at my Chem 24 exam to determine one way or the other, do I really have a good case here because the client's health is impacting the premium? Although I must say that if you need coverage, term on a substandard platform is going to be way cheaper than anything you're going to buy on a permanent platform. Now I've noticed that you can buy several different riders with term. You could do a waiver of premium. Let's say you became disabled and you couldn't work any longer. Your premium would be paid by this small insurance, kind of like insurance on the insurance. You have a waiver. They waive the premium as long as you're disabled. Another one is accidental death. Well, let's say the odds of you dying, you've already been underwritten, you already look like you're preferred or super preferred, depending upon what you receive from underwriting, and you already received yours preferred rating. The odds of you actually dying on a 20-year term is remote to nothing. So what they're going to say is, oh, if you do die though, the odds are it's going to be like a car accident, or you were recreating on the weekend and you were in a boat accident. You're going to have an accidental death. Well, some people will put a rider on top of that. It not only pays the regular term insurance, but then it pays additional coverage because it's accidental death. Some people, and I'm not sure I buy all this from a real look, because people say because most people die on a term contract from an accident and not a disease, maybe we should just buy accidental death benefit. But I've kind of said, no, I still think you need to do term because there are other reasons, because there's not, to my knowledge, there's not too many convertible accidental death benefits out there. Now, child, you could put your children on a child rider. Some of these go all the way up to $20,000 of coverage, usually $5,000 to $10,000. You could also put your spousal rider on it, but I'm not sure I want to do this anymore, and here's why. If your wife's not working and you're trying to minimize the cost, perhaps you should just go ahead and buy a term on yourself and then buy a supplemental spousal insurance. But today, in today's totally changed culture, where mom and dad are both working, now we have dual income raising kids. Now we have dual income no kids. We call them dinks or dirks. If my mortgage is subordinated on two incomes, then I think you need to have two policies that cover both mom and dad. And because we're in such a litigious environment with divorce, over half the society gets married and then gets divorced, I think you might as well just have your separate policies. And if you really want to do justice, you might want to think about having them cross-owned. That brings me to another issue. Ownership is a big issue. You could have an insured, whoever the insurance is on. You could have the owner, who's paying the premium and actually who controls the policy. And you'd have beneficiaries, the people who actually benefit from the policy. The beneficiaries could be prime beneficiaries, like in my case, my wife would be my prime beneficiary. And secondarily, if my wife and I both died in a car accident or whatever, our children would become the contingent. They'd be right behind. And you can do any percent that you want. So if you say, I have 6 children, one of them's a bad seed, I'm going to cut that person out, or they're going to get a reduced benefit, you could do that. So I'm always looking at who's the insured, who's the owner, and who are the beneficiaries, and are they the prime beneficiary or are they the contingent beneficiary? When I've looked at this, I start looking at death benefit, because many of us don't really do the math sometimes. Like, I might buy $250,000 of death benefit, and it's not that much more to buy $500,000. Some of these carriers have break points. They actually give you discounts as you cross into term at $250,000. $500,000, $750,000, and $1 million. Sometimes I like to put both what I was quoting below the break point and also quote the break point, because the difference in money is not that much. So I kind of like to weigh it out, and I like to look at that difference. Here's what you asked me to do, but gee, for about $70,000 more, you'd hit the $500,000 mark. Maybe you should look at that. Now that kind of brings us into the idea of, if there's death benefit, how do I know what I can cover? Well, I gave you a couple earlier on. Maybe my mortgage. That would be a good thing to cover. Maybe my business relationships. Maybe I'm going to do a buy-sell agreement, maybe a cross-purchase agreement, maybe a stock redemption, or this new idea that I really like, wait-and-see trust. All these have to do with business succession planning. And I want to make sure that I've covered all my indemnification scenarios, and in those scenarios where I'm looking at death benefit and I'm looking at the reasons, I'm looking for maybe covering a business loan. If the death happened, I want that loan to be paid off. Maybe I'm covering it for college education. If I'm not around, I still want my children to go to school. There are a variety of reasons, and I mean as long as my arm, there's probably a dozen good listings for why you would consider using term insurance to cover those indemnification issues. And I've just given you a few of those issues. One of the bigger ones now that's becoming really huge is, if you have daughters like I do, well, you're going to have weddings, so there's a serious number. And also on top of that is personal debt has become huge in America. So it's not just the mortgage now, it's all the ancillary debt that we've rung up on our cards. So those areas, any area where if you were to die and that would cause a financial loss or hardship to your beneficiaries, this is why we look at life insurance. And I love life insurance because about 400 something years ago, Sir Edmund Halley built, and you know him, he's the gentleman that actually discovered the comet consequently named after him. Sir Edmund Halley actually wrote the first actuarial table, and we're actually using the basic fundamentals of what he wrote 400 years ago. The Lloyds of London back in the day, in his day, they were always insuring shipping and trade and so forth. And some guy came up with a genius idea that you could actually quantify and put a price tag on human life. Think about it. Back then, the average age in England at the time that table was written was right around 42 years of age. That was the average. So that's pretty young. We'd all be dead. So I'm looking at term all the time in how many contracts. Now, when I look at and I do a due diligence, I can see so many insurance carriers, and I'm going to look at probably 200 to 300. I can do it in a fell swoop because the software competitive grids that they have out now are just fabulous. So I can look at everybody in the term market. You'll never have to say, well, is that carrier good or is that carrier? We'll look at them all. And when I measure that, I'm looking at their ratings. It could be AM Best. It could be Fitch. It could be Standard & Poor's. It could be Moody's. Or the new numerical weighted average, which everybody likes to use. It could be the convex rating. What some do is they measure the carrier ability to pay the claim. The others usually measure financial stability. Are they just stable? Do they have the financial viability to carry on? Because a term contract is only as good as the carrier behind it. So I'm looking at ratings all the time to do my financial due diligence, either claims paying ability or I'm looking at financial stability. Because I want my contract, if I'm going to pay for it, I want it to pay out if death occurs. So when I'm looking at due diligence, I'm always looking at the rating services, 5 to 6 of them, to kind of get an idea of how the world looks at it. And I'm always looking at areas in the actual balance sheet, and we do that here at Brokers Alliance. But the bigger issue is that you can get this. This is all public domain information. You can pick this up at your commissioner's office, and for 75 cents, you can pull the 2 pages that actually tell all on the financial pages, and you can pretty much understand that. Even if you didn't understand a lot of accounting, there's basic premises there. Oh, it's a pretty big company, has big strength, and their reinsurance treaties are strong. Because some carriers like to share the risk, so they may not be able to take $1 million worth of risk. Maybe they only have a retention of maybe $500,000, and for $1 million coverage, they have to go out to a reinsurance pool and share the risk. Well, I've introduced you to basic concepts in term insurance, basic ideas so that you can kind of enter into it. And remember, this is Steve Schneider, National Marketing Spokesman for Brokers Alliance, talking about term insurance, the temporary insurance for a temporary liability.